So I've been getting a lot of customers lately that have 1099 independents doing their distribution. So basically, a 1099 independent is an individual that comes to your warehouse, picks up product, and gets invoiced by the distributor. So basically, independents get invoiced by distributor. So for example, if I come and pick up 10 items at $1 a piece, the independent will have an invoice for $10. Okay? Very simple. Now, this independent's going to leave the warehouse and go to the customer. Okay? The customer can either be two types of customer. So it's either a cash customer or a charge customer. So all the while, the independent has these $10 worth of product on his truck. Okay? So if the independent visits a cash customer, the independent will simply sell from these $10, from this $10 worth of product to the cash customer. The cash customer normally belongs to the independent. So when I say cash, this means that the independent's going to give product to the customer, invoice the customer, collect cash, put the cash in his pocket. Very simple. The independent also visits a second type of customer. It's called the charge customer. So this charge customer belongs to the company or the distributor. Okay? The independent is going to make an invoice for this charge customer. And this invoice will not be held by the independent. This invoice will be held by the company or distributor, however you want to call it. This is the same company and distributor that invoiced the independent for the $10 for the product that he picked up. So you might ask yourself, isn't that problematic? Because if the independent picks up $10 worth of product and then invoices the customer again, and both invoices are going to the distributor, that means that you're double invoicing the same transaction essentially. But here's what our customers do. They go into the accounting system and they make an equal credit against the independent's account. So let's do an example. Let's say that this invoice is for $5. Okay? So right here you have your independent account. Remember, you picked up $10. So let's say we got plus $10. That's his balance. Okay? And now you got the charge customer. And let's say that the invoice that the independent did for the charge customer was $5. Okay? What our customers are doing, they're taking this invoice and they're duplicating it as a credit. So basically they make a credit over here for negative $5. So the independent balance is now $5. Which means that you've essentially canceled out this invoice. Meaning that you're now not double invoicing the system and decreasing inventory double. Okay? So again, how does the independent model work? Picks up an invoice, he gets invoiced. Sorry, picks up product and gets invoiced for it. Then he visits two types of customers. Customers that belong to him that are cash, that he's collecting cash and checks from on his name. And charge customers where the receivable is held by the parent distributor that invoiced the independent. Okay? When this charge customer gets invoiced, the parent distributor makes an equivalent credit to the invoice to cancel out the invoice against the independent's account, and thus decreases the balance on the independent's account. Okay? So this is a money system. Let's say money system. Why? Because the product can't belong to the company and the independent can distribute it. Legally, the independent can distribute product that belongs to the company. So now let's talk about the employee, or the W-2. In this example, the product belongs to the company. So the W-2 employee is not invoiced. What happens here is that product is transferred from the main site to the employee's truck site. So basically, the company takes note of the product that the employee takes with them. So let's say they take 10 cases. During the day, this employee is going to invoice customers. So let's say the invoice is for 5 cases. Okay? Very simple. He took 10 cases with him. He sold 5 cases. At the end of the day, he's got 5 cases remaining. And the invoice that he made right here is going to go to the accounting system. So the receivable goes to accounting. Okay? So in this example, this is a money system, but in this example, you're talking about an inventory system, because you're tracking the inventory of the distributor. Here, you're tracking money, okay? Because the independent owes you, okay? And basically, you want to liquidate that invoice and you want to collect on that invoice. Here, you just want to make sure that your employee doesn't steal from you, because they're just taking your product and they're going out and they're selling it to your customers. So that's the difference between the two business models. And the reason why this is so popular is because it eliminates the need to have a W-2 employee. Obviously, you all know the difficulties that come with having a W-2 employee. And it makes it so you can do everything based on the money, not on the inventory. Which means that here you don't have to worry about theft because you're worried about the transactions. Very beneficial for a lot of companies, and that's why a lot of our customers are doing it.